Welcome to our second episode of BURSA, where we talk about anything financial related to Malaysians. Here on my right, I have Mr. Chuck, who represents the average investor slash person. On my right is my colleague Benny. Further right, who is an expert on trading, right? And he's an expert on technical analysis, anything relating to behavior of investors, reading price and volume.
Actually, why is technical analysis different from what he does? Because he brings out all the charts and everything also onwards. So like,
I think this one is more on the study of companies, the financials and all that. So it's considered like technical as well, because you look at price and whatever data you have.
Right.
But technical analysis is basically purely on price. It's how market react to that stock.
Okay.
So it's like understanding what the market thinks about whatever that's been traded in the market.
So for instance, if it goes up and then down and then down and down and then up again, then there is saying something about the behavior.
Yeah, so it shows you something, it tells you something. So we are basically analyzing the patterns. Yeah.
Because what I do is that just because a company is good doesn't necessarily mean the share price will go up.
Yeah.
Right? Not in the short term anyway. So what I do is looking at the fundamentals, right?
Okay.
So because the stock market is inefficient, right? So which means that even though it's public information, maybe there are not many people looking at it. So there's no reaction to price, either up or down. So that's a big difference.
Right.
Yeah.
So does technical analysis take into account all these like the automating buying of stock?
Yeah, I guess because it's easier, you can build most of the technical indicators, right, are all mathematical based. So it's easier to build algos and quantitative kind of methods.
No, what I'm saying is like, do you actually predict how these AI, bot stock buyers are going to buy in the market?
I think they are. I think right now AI plays a very important role in technical analysis. So they are trying to build machine learning. So they learn all these patterns, what works and what don't work, and then they try to forecast what works in the future.
Then eventually will there be this dystopian future where AI bots are just buying none, then another AI bot reacts to it and sells it, and then another AI bot buys it, and then...
Very true. I think we have seen that happen before in the US.
Oh, is it?
Yeah.
Where? Like
when,
which stock?
there was a flash crash one time. I don't know what year was that.
It was P&G.
Yeah.
The stock P&G, like Procter & Gamble.
Procter & Gamble.
The one that makes shampoos. And
I know P&G lah, not that noob lah.
Okay.
Yeah.
So there was a flash crash where Penny can explain.
Yeah, because all of them, they put these levels where they put their stop losses, where they exit and all that, right? So when everybody look at the same thing and everybody have the same method of getting out, right? And they put in a bot, because bot doesn't think, right? It just execute whatever you put in.
Exactly.
So that's why that happens when everybody execute the trades, the price just fell. But it's just for a short while and then it's just rebounded back up again.
Did it rebound also because of the bots or what?
No, I think people look for opportunities. What happened? Suddenly the price go down and then they just buy in.
Oh, got something like that later.
So there is a difference between bots and AI.
Yep.
So one is algorithmic, that means it's pre-programmed.
Yep.
And a lot of them actually, I can say, is based on technical analysis as well.
Okay, just quickly before we move on, are there more bots or are there more AI controlled purchases now?
Still a lot of bots, still very much driven by the trader or the person who created that bot. Okay. I think AI is still quite new, because it's supposed to be like you learn the whole data, right, without putting inputs, and it's supposed to learn from these patterns of price movements and all that, and give you an opinion what's going to happen next. But I haven't really seen one that works at the moment.
But depending on which stock exchange you're talking about, the stock exchange needs to be able to connect to the bot.
Yep.
So right now in the Malaysian stock market, there's no such thing, right? You can't connect. There's no APIs to connect.
Okay.
Yeah.
So BURSA is unaffected by bots.
Yeah.
Okay, so let's talk about the big news first lah. This one, everyone talk about it. Right? So EPF declares higher dividend of 5.5%. So when I saw this news, I messaged Alvin. I was like, very high, man, 5.5%.
Well, I think for a no risk investment is quite high lah.
But I mean, like historically, because I got this chart that I found where there someone saying EPF is risky, right? in your comments in your Alvin Equities, right?
Yeah.
Then I actually found this chart where this from 2008. 2008 was a historical low.
Yeah.
And then since then, it's only dipped below 5.5% twice, 3 times. Yeah, so the rest of the time is higher than 5.5%. So it's like, even like 6.7, 6%. So I calculated then if you started with 100K in 2008, right, you will have 250K from that, give or take, today already.
That means you would have gained 150K.
Yes, you would gain 150K.
Yep.
Yeah, in your portfolio lah.
Yeah.
So my question is, how the heck does EPF keep doing this all the time, and then other people cannot do this? Like unit trusts or whatever, at least dependably like this like so steady pom pipit one.
All right, good question. So like how these guys work. Okay, so one of the things about a unit trust that's very vastly different from EPF, for example, is that for EPF, once you start working until you're 55/60, you can't take out money, right?
Yeah.
And in case for unit trust, you can put in money anytime, which is okay, which is very similar to EPF. Now this is where the similarity ends, right? You can take out anytime. So what studies have found is that investors, retail investors, right, tend to go in when the market is at an all-time high, and they tend to exit when the market is all-time low, which kind of is counterintuitive to how you're going to create wealth, right?
Yeah.
But because
this
EPF,
is a FOMO thing that we talked about last week.
FOMO, right?
Yeah.
And so if you look at this, where EPF only allows you to withdraw on a selective basis, so which means as fund managers, they have a much longer time frame they can invest for.
Right.
Yeah, they're not, quarter am I making money, will my investors take out money, right? So allows them to hold a much longer view.
So essentially, investing long term is always going to be more dependable than investing short term.
It depends on skill level.
Okay.
So if you're very highly skilled like Benny, who can do short-term trading, great. Like it works for you, but it takes time. You need hours. You need to spend time. But if you go passive, on and off, you want to look at it. Sometimes you don't look at it. Then you need to take a much longer view.
Right.
Yeah.
Right. Are there any other fundamental differences between EPF and something like unit trusts?
I think one fundamental difference, if you look at, EPF publishes their annual report every year. So a typical unit trust will cost about 1.5%
service fees.
Management fee lah.
Yeah.
Okay, on average 1.5. So you want to guess what EPF's management fee is? Now, because also due to size lah, they're managing $1 trillion versus some funds are maybe 100 million, 200 million. So because the base is important, right? So take a guess.
0.7%.
What?
Yeah, I think 0.4 or 0.7.
Yeah, something. Yeah, you should. Oh no, actually 0.07.
0.07.
Correct.
So 10 times, that's 20 times less than unit trust.
Correct. So if you knock that out, you add that back in. So essentially 5.5 plus 0.07, 5.57, right?
Yeah.
But because don't forget they're managing $1 trillion of funds, they literally have no marketing staff because we are forced to.
Right.
Put money. So every month EPF die also they get 4 billion of fund flow.
Right.
So there's no marketing to it, right? So it's purely management only and administrative lah to withdraw lah, right? And that's a very costly exercise when you have to market, brand yourself, and so on and so forth, right?
Oh, so it's removing all these things that they don't need to pay for, like marketing, and then the size of the fund versus the amount of people required to administrate that fund.
Correct.
That's where we get, it's just economies of scale.
Absolutely.
Yeah.
Oh. And it's because it's in the EPF Act. I think, I can't remember the year. So as long as you are in employment, you have to contribute. It's the law, otherwise you'll be breaking the law.
Yeah.
So
it's like unit trust if they got new customers every single second.
Yeah, I mean, exactly.
They don't need to pay marketing.
No need to pay marketing. There's no marketing, there's no branding, there's no sales team, there's nothing of that, right?
Yeah, I think there are also another two more differences. Like one is EPF also guarantee a 2.5% returns every year, regardless, right? If they do bad, they still have to give 2.5%, which I think no unit trust can actually promise any returns.
It's never even gone to 2.5% as far as I could tell.
Never gone
historically.
It was. I mean, of course, you look like 20 years ago, it was higher. It can go up to like 7-8%. It was lah. But even for the past 10 years, they've been giving about averagely about 6% a year in the past 10 years. So it's quite good lah for savings, right? And like Alvin mentioned, you don't take out money, so you're actually compounding, right? And you can actually see the effect of compounding very, very vividly lah on EPF returns.
I actually have one more question, which is that is their dividend rate based on the appreciation of their equities or holdings for that year, or do they kind of average out a bit? In a sense that, let's say, they do really well in 2020 and, they save a bit so that in case 2021 does badly, they can still afford to pay a decent dividend. Do they do that?
Yeah, I mean, it's not based on whether there's a capital appreciation or not. It's based on the income that they get from their investments. So, like, for example, let's say they buy shares, but if they're still holding the shares, they cannot pay out, right? But if they sell the shares and whatever profit that they make from the gains, then they pay out.
Right.
But EPF, like all these big funds, normally they will invest like maybe 60-70% on money market funds, right? Very less on equities and other stuff. So that's why in money market, you get dividends or like interest every year. So that's how they pay out as well.
Okay.
Or fixed income.
Okay.
So they get income every.
But they invest in things like property also, like Better C and all that. They invested also. Right?
Yeah, they do. Yeah, but they get small percentage
Recently.
Okay.
Yeah, and also foreign stocks.
Okay. Yeah. Let's go into the next topic then, which is this. So I saw this news, short selling of CTOS shares. So CTOS, I actually use CTOS. CTOS is like your credit rating thing, right? It tells you what companies you own.
Technically, according to the court papers, they are not a credit rating agency.
Okay.
They are a service provider.
Okay.
Yeah.
But they do that service where they tell you all the companies you own, all the liabilities and all the assets that you have, right?
And give you a
report,
which is essentially what the banks rely on.
Why got 4 fingers here?
Well, because it's actually rating. Okay. What they're doing is they do have a score whether you're good or bad. So, but there's also credit rating as a law, right? But which they don't fall under because they are service provider.
Okay.
So the court is right. They are not a credit rating agency.
Okay.
And that's very clear cut about it.
Okay.
But in practice, what the banks do is they rely on that credit rating score in deciding whether to give you a loan or not.
Yeah.
Yeah.
So meaning to say they're not legally a credit rating, but because the banks rely on them, they are the de facto standard.
One of them. Yes, correct.
Yeah, I think that that lady who sued them, they brought up this one, right? They're not supposed to give rating, so that give her brownie points in the corner.
Right. But what I actually want to talk about is the short selling.
Yep.
And then it was suspended by BURSA. So maybe you guys can just explain very quickly what short selling is versus normal trading.
Yeah, when I explain? I mean, short selling is basically, the term is basically you sell first and buy back later. Because our mentality is like now you actually can sell something but which you do not own, right? And then you buy back the shares later. So if the share price now is high, then you buy at a higher price, right? And when it comes down, you sell at a higher price now. When the price comes down, then you buy back at a lower price, so you make the gain. So that's short selling in a nutshell.
Like you're betting against the share.
Yes, so there are 2 types of short selling. One is basically a naked short, that means you don't own anything and you short, right? Which is normally allowed in the futures market, not in the stock market. But in BURSA, they also have this thing called an intraday short selling, where you can actually do a naked short without owning anything. But it's only limited to intraday. That means within the same day you have to exit that short.
I'm getting that harap rancangan tergendala sebentar thing already. So many terms in the futures, naked shorts, which I don't usually relate to stocks, but
naked means there's no underlying.
No underlying,
Yeah, that's usually what naked means, Okay, so wait. I am familiar with the term of shorts because I watched that documentary, which we'll talk about later after this. But is BURSA allowed to do this? Like just stop trading?
Yes, they are allowed because they are the regulator, so they set the rules, right?
Okay.
And mostly when they also have certain rules, like they call it limit down. Like if the share price falls below 30%, they actually have the right to stop trading for that particular period.
Compared to other markets around the world, is this a normal practice?
Some do, some don't. I'm not sure about the US, but in Singapore, they call it the circuit breaker. Yeah.
So if it's just too much of a swing, they will just cut it off.
Normally for fall in price but not increase because people lose money when the price falls. When the price goes up, it doesn't. But then again, BURSA also has this thing called UMA, unusual market activity. That if the price goes up so fast for no reason, you haven't found the reason yet, then they also have the right to actually stop that trade.
Are these things good or bad for the market?
well, when it comes from the regulator, it's supposed to be good for the market, but of course some people was not happy about it also.
Right. Understood.
I mean, it's...
Because there was a second instance here also. So AirAsia also kena earlier this month.
Yep.
AirAsia X, sorry. How often does this short selling happen? Like, is this a common thing? Because I just saw these two in the news like recently. Is this like getting more common or?
I mean, the whole idea of a circuit breaker is to give it time, because in the short term when you have no time, then you react, right? And I think that's the purpose. Is like, after 9/11 attacks, they closed the stock market for 4 days, right? Because people needed time to sink in what is exactly going to happen, right? Of course, it didn't stop the market from falling. It probably cushioned the fall, right? Because
kind of like letting cooler heads prevail.
Yeah, that's right. So it's time out. That's when we're kids, we get punished, right? Hey, time out. Like, just to reset.
You got time out, so I got rotan.
Fortunately, they don't rotan us lah.
So it's a time out. Not necessarily a bad thing, but of course, the opposing view of having a timeout is that, hey, you know what? A free market is not supposed to have a timeout. Let the market react, right? So there's no right or wrong view here. Yeah. So if you're a bit more prudent, then you have a timeout.
Because I would compare it to something like this, which is I just watched this on Netflix, Eat the Rich, the GameStop Saga. Yep. So the way this works, let me try and explain this, is that GameStop was a stock that was going down, and all the big investment firms knew it was going down, and so they shorted it. Shorted it basically meaning what Benny said, they are betting for it to go down, right? So the problem with betting for it to go down is if it doesn't go down, your risk is infinite, because it can go up and up and up and up and up. And a bunch of people in Reddit on this, what was the Reddit thread called again?
Wall Street Bets.
Wall Street Bets, yeah. Wall Street Bets all banded together to buy GameStop, to show the middle finger to all the big investment firms. And then the stock went up and up and up and up and up and up. And then basically all the investment firms didn't know what to do already, right? Yeah. And then what happened was
they lost money, that's for sure.
So investment firm actually went bankrupt, right? The biggest one.
They bust, yeah. Two of them, I think.
And then at some point in time, the company that was facilitating all these purchases, Robinhood, suddenly stopped purchases on GameStop for 1 day. Was it 1 day?
I'm not sure. I think a few days.
Okay.
If I'm not mistaken. Yeah.
And basically from there, everyone panicked, and then it started to drop. Is that the way it should be, or?
It's like, I wouldn't say it's a free market, but of course people with a lot of money can control markets.
Right.
And that's why there are rules and regulations to avoid that. But despite the rules and regulations, people still have a way to do it.
Right.
Yeah. So always people, big corporates against the smaller guys like retail investors, right? Retail investors are always at a disadvantage. Number one, because of the information and skill that they have. Number two, money right? So money controls everything, right? So
this was a unique situation where all the Redditors banded together and then all decided to
because most retailers are free, right? They are very decentralized.
Yeah.
So I guess the biggest fear for any hedge fund is that these retail guys
all band
together and find a common purpose, right?
Yeah.
So far in the history, there have been a few cases, very early on. If you go and Google, Occupy Wall Street is one of them, but that was just a protest and camping in a park and things like that, but less to do in actual seeing the stock market, right? Because it's always the narrative is always Main Street versus Wall Street. And I think this is where we're seeing that fervor, right? The underlying fervor where it is unfair. It is absolutely unfair, right? So it's always a small guy versus a big guy, right? Yeah. So
how do retail investors navigate this, knowing that they're at a disadvantage? It's like going to a casino, right? The house always wins.
Correct. House always wins. Yeah.
Yep.
Yeah. Correct. So is that the same way that
okay, now I don't think it's the same as the casino, because based on probability in a casino, sure lose, right? Odds are against you, right? But I don't think the odds are against you in stocks or in these markets, right? Only if you're equipped mentally with the right mindset and education. Doesn't matter if you're small, right? So let me give you an example, right? So if I'm a big guy and I want to manipulate prices to go down, but if you are value-based and you know the company is worth a lot more, of course, typically when it's pushed down, what you want to do is invoking you to sell as a retailer, right? So if you understand the business and you have very strong heart, let's use the word heart, and you believe in this, and very few people can do this, right? And they know this, then eventually when the price goes back to where it should be, that's where you gain. So it's really testing your patience, right? So that's one way. Of course, when it goes up, can you resist the urge not to FOMO?
Yep.
Right? And that is key, because that is absolutely key. And it comes through experience, through education, dedicating yourself to this, right? Because it's not just the technical skills that you need to gain, but it's also your mental.
So that's the difference between you and Benny, because when Benny does technical analysis, he's betting on people to FOMO.
Well, because it depends on the price movement or price action, right? When there's FOMO, of course, the price will go up, right?
Okay.
When there's fear, there's two emotions in the market, fear or greed, only, right?
Okay.
So when the fear happens, and if we know that the fundamentals are still good, that it's going to come back, that's why we take advantage of.
Right.
Instead of just like buying and holding for the long term, you go through that ups and downs because you believe that in the long term, the company is still going to do well. Right?
Okay.
So I take advantage of this, right? When, so I can actually try to identify when the price is low and try to buy it at a lower price instead of just buying and holding it.
Right.
So it gives an additional advantage if you know what you're doing.
Yeah. And also, to be honest, I've never watched this. Although I've been following the story in real life when it happened. I think Hollywood really over dramatizes
yes, definitely.
the finance sector. Because we're in this space, right? We know a lot of this is not true. So sometimes I don't watch, and it was very cringe-worthy watching.
Which one?
What's that?
Big Short.
Yeah, like Big Short. What's the other one called? The one with
Margin Call.
no, there's
Wall Street.
Boiler Room.
no.
Wolf of Wall Street.
Wolf of Wall Street.
Wolf of Wall Street.
Hey, Wall Street totally different lah.
Drama.
Yeah. Speaking of drama, okay, let's take a short break first. We'll come back after we refill our coffees lah. Okay, we're back. And I just want to move cogs to something a little bit more casual since we had so much technical stuff just now. 16K in savings at only age 30, I need help and advice on adulting. So basically this fella posted in Reddit in the Malaysian PF channel. And basically just got back from overseas. He was earning 3.5K. Now he earns 5K. And actually 16K for 30, I had about 16K when I was 30, even though that was about 15 years ago. So I guess times have changed. Do you think this is decent?
Hey, you know what? Kudos, at least you have 16K in savings, because I think looking at current lifestyle habits and of course cost of living has gone up.
Yeah.
I think more people are in negative than in positive. That means credit card debt and so on and so forth, right? So I don't think you should, beat yourself up too much.
Yep.
Yeah. Like compared to what you had when you were 30?
I don't know, I think I spent everything and got into credit card debts,
Let me remember when I was 30. I was in. So whatever extra. So what I did was I put investing first. So whatever I have, it just goes into investing. So including even if means that I have to survive on my daily expenses using credit card.
Wow.
Yeah.
Wow.
Yeah.
Okay.
So, but of course, I had a very extreme view, So
keep in mind, he owns a company called EquitiesTracker, So I mean, he's not representative of society in general. Yeah.
So that's.
This is more general, right?
Right. Okay.
I was the
Gambling guys.
I think that's what makes us a little bit different, because you always look at the long term, I always look at the short term.
Right.
But until now, right? Because whatever I made money from trading or whatsoever, I spend it. Never thought about like keeping and investing and growing and compounding and all this kind of stuff. I never thought of that earlier.
Right.
Yeah.
And then what would you advise him right now with 16K in savings at only age 30? And basically, he has a tendency of spending it whenever he doesn't do something else with it.
Yeah, I mean, this peer pressure is real. I guess that, especially today, right? When you go Instagram, you see people live like, wow, this guy have very nice clothes and this kind of stuff, and you want to be like them, right?
For me,
Yeah, the good thing about EquitiesTracker, our uniform is just t-shirt and jeans, so can wear the same thing every day.
The funny thing is, he's not even buying real clothes, he's buying skins for CS.
It's peer pressure also lah.
Digital skin, right?
Ayo, bro, buy some real skins lah, like this, yeah. Uniqlo here.
I mean, he also mentioned that he bought like an iPhone and some expensive stuff.
He regretted later, right? He says.
Yeah.
So yeah, I mean, that poison or racun is real lah.
Yeah.
Like for example, myself and I like to ride bikes, right? I was, when I was young, I was riding, and and Harley Davidson was basically what I want to ride.
Oh yeah, I saw you on the way to work the other day, man. It was damn uncomfortable. It's like, what the heck, man?
Mesti ada gaya lah.
Oh, look like doing Karate Kid or something like that.
Yeah. So for me, I don't try to get any loans and all that, because motorcycle loans are very expensive. It's much more expensive than cars.
Oh yeah, we talked about this, right? Car loan is like what, 7%, 6%?
Car loan is, I think, about 5-6%.
5-6%, and then motorcycle is?
Motorcycle is sometimes can be higher than personal loans. It can go up to like 9-10% a year.
A year?
Yeah. So I did not want to pay the banks lah, after getting out of credit card debts, right? So
it's just a delayed gratification lah. So I just want to make sure I make money first. Instead of like now you get your bike now and you pay for the next 7 or 9 years. Some people go like 12 years. It's crazy lah, right? So instead of doing that, I just wait for the next 7 years lah. And then you can still get the bike. Yeah. So again, but the poison is real. To get that bike because everybody is riding. Your friends are riding. It's the same thing like if your friend has an iPhone or whatever, you also wanted it, right?
Yeah.
So it's personal lah.
But like what Alvin mentioned earlier, I think from what when I have kids, then I really think about longer term, right? Because when I started, nobody taught me about personal finance. In fact, I have a story of my grandfather lost everything, right, in gambling. But
oh yeah, your grandfather's story, I remember that.
My grandfather's story.
A real grandfather's story.
It's a real story lah. It's a real story lah. So yeah, but then when you think about it, it's like you have to
manage money well, basically, right? So you do not want to deprive yourself from what you want.
But you can delay it.
You can delay it, one thing, or you can just find an alternative,
Yeah, I agree with that 100%. I think a lot of people, when they take a 9-year car loan and they're paying 3K a month, they don't realize that 3K can get them a very nice holiday every month. Now, is that really worth more than the car that you're paying for? It's debatable, I guess, to each their own.
Yeah.
Okay, very cool. So you're doing okay. If you're looking for a place to invest, do check out EquitiesTracker.com. Yeah, there's a lot of good stuff there. All right, next thing we want to talk about is REITs. Now, I've been saying this REIT thing a lot. I
think it's pronounced REIT.
REITs.
REIT is a
this is REIT.
That's right.
Okay, fine. REIT. Okay, REIT. So they're basically real estate index
investment.
Real estate investment trusts.
Yep.
Okay, so as I understand it, it's basically like giving money to someone to buy a bunch of properties and see how much money these properties bring back. Right? Essentially, that's it, right?
Something like that lah.
Okay. Yeah. Why are they gaining in popularity now?
Well, I guess it gives investors having a leg into the property investment, right? Because traditionally, you want to invest in property, you actually buy that property lah.
Yep.
And you need a bigger capital outlay, right? And you have to pay the banks and all that. But when it comes to REITs, it's more like a group that gets together.
Yep.
Again, we call it the trust holders lah, right? And so someone managed that fund to invest for these guys.
Right.
And in REITs, you don't need to have like a 10% deposit,
which can be thousands of dollars. But
so you can buy as much as one lot like any other shares.
Don't need stamp duty.
All that lah.
So it gives us a more flexibility as an investor to invest in property market.
Are there REITs in Malaysia also?
Quite a lot.
Oh, yeah.
No, I think there are.
But given the real estate market now, is it still like a good investment to go into REITs?
Actually, REITs.
REITs.
Red color shirt.
Okay.
REITs have been around for quite a fair bit of time.
Okay.
I think it gained popularity in Singapore largely maybe 20 odd years ago.
Okay.
And then Malaysia following maybe the last 15 years. I think our oldest REIT is probably 12 to 13 years old today.
Okay.
I remember it's Axis REIT lah. That's the first REIT that was listed, and then followed by YTL and everything else. Like what Benny said, it's maybe one of the oldest fractionalized. Fractionalized property investing vehicle, right? That's what it is, lah. So it's very much income driven. So a lot of the part of the rules for REITs is that it has to distribute 90% of its income every year.
Oh, okay.
Right. So the REIT will buy that property, lease it out, and then minus management fees. They have that much. So if they made $1 million, they're going to give back at least 900,000 to its trust holders. Right. So it's like a unit trust, but like a unit trust that has an NAV, right? And the holder actually gets paid a dividend every year. Or
Right.
They call it a distribution, not dividend.
And the REIT price itself will also go up every year or go down, like an equity.
Yes, that's the idea, right? Of course, that's the idea, but markets are inefficient, so sometimes it can go lower than what the property is worth as well.
Right.
Yeah.
Okay. Interesting. Okay, thanks for clearing that up. Okay, so this is the big one. 99 Speedmart files for IPO. That's probably the biggest IPO announcement so far this year, right?
Yep.
Any thoughts
Yep.
on where this is going?
Well, I think the easiest
Without
comparison-
recommending stocks, because we don't recommend stocks, okay?
Yeah, because I've looked at their offering, right, and it's pretty much similar with Mr. DIY, if you still remember, in 2020. They're also retail, right? So it's different. They sell different products, lah.
Yeah.
But Mr. DIY also raised 1.5 billion from public
Yeah.
ringgit, and
Yeah.
they also raised 1.5 billion. So it's somehow comparable, lah.
There are parallels, lah.
and it's because it's retail. Everybody understands the business, and Mr. DIY I think was oversubscribed by nearly 4 times.
Yep.
Right, and they are able to raise their funds. So, yeah, so this is also an easier to understand. I guess this will probably be oversubscribed as well.
Sorry, I know this is something that you always talk about in your trainings as well, that you say that retail stocks are easy for people to understand. How does that affect the price and the purchase decision? Like, is that a plus point or a minus point?
Well, knowing the business is one thing, but whether the company is making money is another thing, right?
Okay.
Because, just share what happened to Mr. DIY, right? The moment it got listed, actually the share price went up. The first day itself of trading, it went up about 9%.
Okay.
So it was the IPO price was 160. So the investors who got in the IPO is 160, right?
Yeah.
And I think about 6 months time, the price actually went up to 280.
Yep.
And guess where the price is right now today?
$3.
No, it's below IPO price.
Oh wow.
It's trading at 148
Okay.
today.
I did not know that.
Yeah.
So okay. Let me try and digest this a bit. Is there any key difference in how stock prices behave when it's a retail business or when it's a B2B business?
How the price behave? I think price behave in different categories of stocks.
Like are retail stocks more open to market sentiment than B2B stocks are?
Yeah, but I think it depends on how much the retail has a portion of shares in the whole shares that's available. Like I think Mr. DIY is only like 15 or 20% public shareholding. So it means the major shareholders are still the previous owners, right?
Yep.
And they can actually control if they don't want to sell the shares, then the shares will not go down, this kind of stuff.
Yeah.
So if you look at most of my observation is if you look at most of the consumer stocks, the price is not as volatile
Oh, interesting.
as more like speculative stocks, like technology stocks, all this growth one and all that. They are more volatile in general.
Okay.
So retail consumer stocks for I look at it is like look like Nestle and Dutch Lady, they don't
Because
need that
people
much.
always need milk, diapers, the consumables. They're not going to stop buying these things.
Yeah. That's why the analysts always call the consumer or retail stocks as defensive stocks. Yeah, because
Resilient.
it's resilient lah. Yeah.
But then Mr. DIY dropping, is that because Mr. DIY is not so much of a FMCG? Actually, Mr. DIY is technically not a FMCG. It's a hardware shop.
It's a hardware shop.
Yeah, that sells.
Retail distributor.
Yeah.
Same as, it's a retail distributor.
Right.
Yeah.
Yeah, I guess when the market starts to realize that, hey, I mean, this company, I know it's big and all that, but their financials are not improving, and any companies where the financials are not improving, it will be punished in the share price lah.
Right.
Yeah.
Okay.
But I think to add to that point, I don't necessarily think that retail businesses attract more retail. Because if you look at Nestle, because Milo and Nescafe and all, we drink it every day, right? But the share price is like $100, right? So it doesn't attract retail investors in. more it attracts fund managers or institutions.
Yeah.
So not necessarily. So I think there are a lot of factors, but we've not seen that connection.
Okay. All right. Let's move on to the last topic for today. So this is the big news that came out just yesterday, just before we're shooting this. Basically, Malaysia receives an offer to host the 2026 Commonwealth Games. Cost is going to be 600 million, and the only reason why we were offered it is because Australia said, no thanks, mate. Yeah, that's going to be a little bit pricey for us. What are your thoughts on this?
Well, I don't know why. I mean, I don't know why Australia had to withdrew, but and why Malaysia will be interested in this. I've got no idea, lah. But I think from the Taylor Swift concert thing, that makes them thinking that maybe this can bring additional revenue, because from what I read, I think the Singapore government spent about nearly $14 million to pay for the 6 concerts for Taylor Swift, right?
Yeah.
And analysts were forecasting that they're going to bring in like $300 million of tourism money. Right, but that's Taylor Swift lah. Commonwealth Games, I don't know lah.
Like, can you foresee the Commonwealth Games bringing as many people in as Taylor Swift lah? Like,
I don't know. I mean, how many people actually watch the Commonwealth Games?
Actually, I haven't watched it. Have you watched before?
I have actually.
Oh, really?
1998 Commonwealth Games.
Wow.
Yes, I went for the diving one in Bukit Jalil.
Oh, so you actually went to the stadium itself?
Yeah.
Free ticket?
No, I paid.
Wow. Why so interested in diving one suddenly?
I don't know.
Was it because the stock market was diving that year?
No, I wasn't. I was still in school. I was still in school, yeah.
Okay.
Look, I think Malaysia can consider, because 600 million investment, I think we need to look at the breakdown of where that investment is going. Very importantly, because it's all about how does it flow into the general market and has that multiplier effect. So, for example, if 600 million only went to one corporation, it's unlikely going to have that ripple effect in the economy, right? If we say 600 million is on building roads and some infrastructure that's a little bit more distributed, you're probably going to see a lot more of that knock-on effect in the economy, right?
I mean, there's a few ways this happens, right? So part of it is you're putting money into jobs and fulfillment and all that. And also, hopefully, you're getting money from tourism, for people coming in to spend within Malaysia.
You should.
Those are the 2 plus points that we're looking for, right?
Correct. So we're supposed to have that 600 million. How much multiplier effect can we have? But that being said, we do have Commonwealth Games facilities that we built in the 90s, right? I'm not sure if that can be repurposed or upgraded or whatever.
So maybe we can get a discount.
Yeah, because the investment is already sunk in, right?
Yeah. But this 90s way.
I think can. I
think they built Bukit Jalil, that sports area from the Commonwealth Games.
I think Backstreet Boys can get EPF already,
I don't know the details, right? But does it have the knock-on effect? I'm not sure. But it'd be good to have putting Malaysia on the map again. Not a bad thing. Yeah.
At least for the good reasons now.
Yeah. Okay, I think that's all the time we have. Chap, thank you very much for your time. Benny, right? I hope you guys enjoyed today's session. Don't forget, like, subscribe, comment, give us your feedback, and then we'll be back with the next episode of BURSA. Thank you.